Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming in TikToker. Let's jump right into the trading room here and take a look at the price of gold. Up $38.70. Trading last at $18.97, $98.40 last. The market obviously is in an uptrend as the low that was made here at 1820 just a couple of days ago on the 14th. Today, December 17th, the market is trading at a high of 1902. So this is what you call volatility. And it's a trader's dream come true if you manage the risk properly. And we got some positions here that are building quite a bit of equity this morning, and we have entered into an area that obviously is moving up into the weekly target of 1904. So let's trade this morning and make some what I call moolah. Let's make some moolah. Christmas came in early, everybody. Merry Christmas. And I hope that you and your family are having a joyful and peaceful time. My prayers are with you. For us, Christmas came in early, as you can see. So let's see what the market is telling us here on the bigger picture. The monthly sell one level is 1913. So this is basically the signal that we're targeting. The target, you might say, that we're looking at for the completion of the monthly pattern that begun when the market, closed about 1840. If you review the videos that I've been doing here, and I have, 260 hours of live trading, and you can review every one of them. I talk about the relationship of price when it crosses the average price, whether it's daily, weekly, or monthly, and how significant that is. And in terms of momentum, in terms of volatility in the market, regardless of whatever the fundamentals are. The VCPMI is an algorithm that is written in C++ and TradeStation that identifies for you the extreme levels of the supply and demand within a trading session, whether it's a daily, weekly, or monthly. And the core principle of the algorithm is trading the reversion to the mean principle. Upon identifying the extreme levels above or below, then it identifies basically the average price, which is the equilibrium of supply and demand, regardless of what session or what market you trade. And it identifies mathematically where the probability levels are. So we're looking at the monthly signal when activated from standard deviation 50/50 at 1840. It automatically identifies 50-90% volatility standard deviation relative to the implied volatility to the mean. So what it say basically is that at 1913, the monthly signal is telling us that we are entering at that point a mathematical probability that the price is entering what it's called an overbought condition, and it identifies the trading range of distribution of supply now on a monthly level between 1913 and 2045. the first thing we want to see, obviously, is what the market does when it gets up to 1913, or what it does when it gets up to those targets upon completion of those expected targets. So we obviously have broken through the market on the short term. We came down to 1820. We've had this buy one weekly target all week at 1819. It was published Saturday for the benefit of our subscribers, our traders, in our private trading room. And we were able to prepare the volatility, or the breakout, you might say, from the extreme below the mean. And upon entering above the 1840, as you can see here, which was the now buy one level, or going above the monthly level of 1848, you know, we really kicked in the momentum of the market. The market, or the price, basically identified that upon trading above this average price, then we're going to get a momentum that identifies the targets above that you see in red. On the daily, as we came in today, the targets were 1877 to 1884 completed. The market trading above the daily of the sell to level now is neutral. You don't use any more pivot points above the sell to level. Why? Well, if we go back to conventional technical analysis, when the market breaks resistance, this resistance becomes support. And so the market breaking this resistance now, completing the target, reverting back to the level below, activating a short trigger now as for day trades about 12:45 a.m. I keep waking up around 1:30, and I could see why. You know, I look at the market and it's up, and I say, oh, let me go back to bed. It's too early to trade. And sure enough, it unfolds into the target, completes the target. 84 to 77 is a nice a trade that takes place between 12:45 and 2:30 a.m. And it activated, obviously, a bullish signal here. The difference is that, again, looking at the AI, it tells you when the market is trading in this area now, which is the daily distribution of supply, you don't buy in here if you know, in terms of day trading, short-term trading, because you're looking at probabilities within that segment or within that time frame that are extremely overbought. Nevertheless, you know, the market can get more overbought. Comes down, it identifies buyers again, it runs up, closes above that level, and that level now becomes support because it broke resistance. Resistance, when broken, becomes support. The algorithm goes neutral on the daily, and the weekly targets obviously are the next targets that the market activated by coming down to 1848.20 and activating the bullish price momentum, automatically activating the targets of 1874 to 1904. 1902 is the high so far. We're waiting for this weekly now target to be completed. And this is where, depending upon your profile and how you're coming into this move, is where you can begin to recalibrate or trade around your position, you might say, to lock in the balances, which is what I do, which is what we're doing. And that's what we teach in our trading room. Basically, the name of the company is Equity Management Academy. It's for a reason, because what we teach in our trading room, in a private trading room, is how individual traders, self-directed individuals, can use this VCPMI to manage their risk according to their profiles, and basically manage your position intelligently. It's a mathematical probability model that I use myself, and I think we're over 400% return so far this year, and we're ending this year roughly at that number, if not greater. So what I do here is real trading. I show you as a courtesy in a simulated platform, Thinkorswim, so that you, as a self-directed individual, can decide to trade or not. Our traders in my live trading room obviously know the signals, and they are trading in real time. And I do execute this information in real time. If you want to see the track record, basically, that we have, you can go to, I'll show you here, MI2TradeLiveSignals.com, VCPMI Live Trading Signals. And this gives you, so far, where we are today, which is about, as of the post of this, 980,000. This is on a 250,000 account. And to be honest with you, I have still some positions from March that we've been nursing, that we've been keeping. We bought some insurance on those positions, and they've come back tremendously now on this move. But it gave us, at that point, the opportunity to average again into the market. And here, the overall basically is these results that we have here. And so what I do here in the trading room, ladies and gentlemen, is what basically I execute on behalf of my real account here that we show here. The other way that you can take a look at what basically, to be very transparent with you, what we do or how this can be applied, is if you go to VCPMI.com, and this is a day trading program that is called a letter of direction program that is executed by a designated broker of your choice, and we pretty much send the signals directly to their trading desk for the benefit of your account. And so far, we've only had 1 month in 6 months that we had a losing month, and that was in the month of October, where we lost $89. So far for December, we are up about $1,300, and the account, total balance on the account is $33,497, and this initiated trading with a $20,000 account. So this program, which is one of many that we have, is up 68% in 6 months. And it's real trading, and it's traded and executed by a designated broker. Now, why am I doing this? I'm showing you basically the different possibilities that I apply the VCPMI, and not to tell you or show you as much as how great of a trader that I am or how much money I'm making. And, that, in my opinion, is irrelevant to your success as a self-directed individual. This is the way I coach and teach, that if you follow the VCPMI, artificial intelligence, the methodology, the application, then you should. There's no reason why you cannot accomplish the same results. While we have a little time here today, let me kind of show you what we do here. This is the website, our website of the Equity Management Academy. For those that have not gone to the website, feel free to go there and browse around. We published a book pretty much that describes in detail the components that make up the VCPMI. For those that are interested in getting it, just reach out to us, reach out to Ticket Talker here directly, and request for the book. I think you will find it very refreshing and will understand a lot of the methodology that we apply here. We also obviously have a video that you can see here that describes the algorithm in your own time. Obviously, you can take the time to see pretty much how it works. We give a great deal of support to serious traders that are interested in finding a trading tool, basically, that has validated itself. In over, I would say, for the past 9 years, it has proven itself consistently overall to be an exceptional program. In the beta testing that we did, now that we have the real testing, obviously you can see how I use it and how I'm trading it. But I make a point of educating those that are serious traders in how to apply this as a GPS to your trading. It is not, 100% guaranteed, but it does put you into the 1%, you might say, or 10% winners circle, you might say, in the commodity markets that do trade successfully these markets, as opposed to 90% that you can see the statistics show lose in trading the futures markets in particular. So I use the VCPMI in a futures contract so that I can identify mathematically the extreme levels of the supply and demand. And as a trader, that's what I trade. And it's bringing in the basic concept of floor trading using, pivot points. Floor pivot points are one of the common technical analysis. But it's a combination of instruments. It's a combination of metrics that we use. That is a combination of Fibonacci sequences. We use Fibonacci retracements, Fibonacci trend lines, wave counts, WDGN formulas gives us these probability levels that upon confirmation of the market do tend to unfold and produce the results that you're looking for as a trader, without guessing, without using emotion, without second guessing where the market is going. Right now, the market is entering into a highly emotional level. 1900 handle, if you recall, was the breakout before we ran up to 2089. And if we close above 19.4, which is the weekly level, obviously, then the weekly program will go neutral, as the daily is, because then this 1904 will become support for the next fractal in price, and that will transfer the signal to the monthly levels. So as the program completes the patterns daily, it goes neutral. Then it looks at the weekly. Upon the weekly completion, it goes neutral. Then if the weekly goes neutral, then looks at the monthly. Targets and so on and so forth. So the market on the monthly now signal is identifying the target of 1913. So what we have going here is a weekly signal now and a monthly signal in an uptrend. And the targets, again, are into that 1904, 1913, 2045 is the upper end of the monthly. So what we want to see is how much buying strength, okay, can penetrate this level that begins to identify the possibility that supply can come into the market. So what makes the market basically is the distinction of the strength of the supply or the demand that's coming into the market, which is reflected in the price. So if the buyers or the demand can absorb the selling pressure from these levels or go through the resistance of that selling pressure, it begins to absorb all of the supply, and it begins to reflect in the price moving in that direction as more buyers take over the supply that's being offered. Now, what I want to show you here is that here's an impressive amount of buyers that came in, you might say, that was identified by the market, and it was about 11:15 a.m. yesterday when the market came down to a low of 1848, and that was, again, we're looking at the monthly numbers, the average prices here, and so that 1840, 1848, 49 was a very strong level that identify a harmonic relationship, where possibility is that major alignment occurs, creating a level which is value, creating value, where you're going to see buyers come in. And sure enough, on this bar, you can see the green bar just exploded from that level. And basically confirmed, that the buyers were greater than all the selling pressure that occurred here in this process. And it began to move up in the direction of the momentum, which is up. And so this is how I combine, basically. And I'm using the gold market because, in all honesty, the way that I have found works for me, which is really important. And one of the points I want to make is that, this is what you have to find, is what works for you. Trading is a very individualistic process, and that the more that you eliminate the emotion or the chatter influence, and you adhere and you listen to the market, particularly now that the fundamentals have been shattered, they've been broken because of this pandemic, and we are trying to identify, so to speak, the light at the end of the tunnel economically. the fundamental market collapsed in March. And so the thing that basically kept the market going and kept the market alive is that it made the change in paradigm from a physical market to a virtual market and into a virtual economy. And, I think one of the reasons why I feel kind of excited about the opportunities that are being presented right now is because the difference between what we're experiencing right now, as dark and as deep as it may be, is simply what one can be looking at: a big margin call in the economy, a big margin call on the US dollar, that the US dollar, has to come up with margin, means stimulus that is being called by the market, as it has a base, an asset base that it can leverage from. It's the same principle for the markets. So the fact of the matter is that if you look at the US dollar as the world's reserve currency, again, as the amount of supply begins to come into the market, which means stimulus, if you think about it in those terms, it threatens the integrity of the purchasing power because it devalues the dollar. It makes the dollar go down. More supply of dollars makes weaker dollars as a commodity. And that's basically what we have, is that in March, the gold market transitioned into what it is and unfolded into a currency, into a risk asset. Even though the dollar short-term benefits by the safe haven interest, you might say, that comes in from the financial markets, from the international markets, the relationship to gold, as I use it as the measure of currency, of value intrinsically to the dollar, as it always has been, except for 1971, after Bretton Woods, it pretty much, Nixon eliminated the gold standard from the US dollar and became the US dollar petrodollar, the US dollar world's reserve currency, based on the faith and credit of the US government, and opened up the acceleration of the devaluation of the US dollar as we went into a debt economy. If you think about where we were in 1971 with regards to the debt, with regards to just the trade deficit, the debt, we were talking, a few hundred, $1 billion. Where we are today is at about $27 trillion in debt. It's a staggering number that it really begins to question the integrity of the US dollar as the world's reserve currency with such tremendous debt. Now, the great thing is that the US, as opposed to their creditors, can print as much of its currency that it needs, as opposed to our creditors that cannot print. And if their gold reserves, are below standards or below manageable levels, we're going to see, as we have seen, defaults on loans, foreign loans, as we did back in 1948, in 1981 with Mexico. And the only alternative that Mexico had was basically to devalue the currency. And I'm pointing out to 1981 because 1981 was the beginning of the devaluation of the Mexican peso, and the Mexican economy went into not only inflation, literally overnight, but hyperinflation. The peso collapsed from 16 to 46, literally overnight. Was almost like saying, a gallon of milk went from $1 to $4, literally overnight. And this is what the people were faced with. And this is how they paid the loan, by devaluing the currency, reducing the debt in that currency, and transferring that devaluation to the main street, to the people, through inflation, through hyperinflation. This is the other side of this tremendous spending spree that we have going on, that unfortunately has to happen here. We have to have somebody that comes in on the other side to provide the the trust and the confidence of solvency in the financial markets. Otherwise, we're going to see a major implosion of the financial markets, financial assets. And so in order to keep the system going, the machinery going, obviously, which is the printing machine, the U.S. is the only printer in the world that can print U.S. dollars. And what we're seeing is, obviously, countries like China, Russia, third world countries that are indebted in U.S. dollars, that do not have the reserves, the appropriate reserves, are beginning to feel the credit crunch again, as we begin to see tremendous demand again come into U.S. dollars. And the U.S., in order to accommodate for that demand, because the U.S. dollar, regardless, it is the only currency in the world, that again can print money, and basically is, or I should say was at one point, the strongest economically, based on the standards of debt to ratio to GDP and so on and so forth. The debt to GDP ratio exceeds 120%, depending on, how the numbers change. And that is an unsustainable, I believe, level in order to create economic recovery. And so not only has the government come in order to create that economic recovery and trust, drop interest rates down to zero, where, it makes literally free money. And if you have money in the bank, then you're going to have to pay the bank. In Europe, it's negative. So what kind of world are we moving into, where if you want to keep your money in the bank, you have to pay them instead of them paying you for using that money? Things have, kind of turned upside down a little bit here, and I think we're entering a period of acceleration in the recalibration, you might say, that we have coming in the economic system to adjust this debt, a world debt that is just exploding as a consequence of this additional lockdowns that are taking place regionally and internationally, and causing tremendous havoc in their own economic circles, which eventually reflects the overall picture of the world economy, whether it's here or in Europe. The whole system economically is being shattered. And so it's a question of how much money, first of all, they're going to print. According to the U.S. here, they're talking about, under $1 trillion, and they've come to terms, and it's so politicized that it's almost a drop in the bucket, to be honest with you. The market is screaming, and it calls for more money, and it's going to be bigger than ever as we move into next year, once this political nonsense gets put behind, get puts behind, and the administration clearly takes control. So far, obviously, the Biden administration is the leader and the president to be. So we'll see. But that even is still a question, according to Mr. Trump. It's just amazing the environment that we've evolved into, not only, politically, but also in terms of creating the psychic of the American public. It's so divided. It's a situation that is could be potentially explosive, and particularly because the pressure is economically, the pressure that this pandemic is causing economically can translate itself into anxiety politically, and we can begin to see a lot of resistance and a lot of angry people, reacting to this situation here. They're talking about, after all is said and done, let's say on this latest bout of stimulus coming out, they're talking about in there is going to be like a $600 check for individuals and families. I don't know how $600 can make a difference here when people literally are unemployed and have been unemployed for the past 6 months, have not paid rent, and we're in another lockdown here. It's really pretty much kind of almost questioning for me, what's really behind this thing here. The fact of the matter is, as I see it, is that as we move into this year, next year, we're going to have a new economic system. The economic system is going to be reset. And it's a question of, how it's reset. It's a question of, the role, you might say, of gold as a currency, and also the role of, for example, Bitcoin, which is explosive today. You're looking at market at 3092 on Bitcoin. It's just breaking out in a breakout mode, and acceleration just explosive. And this is pretty much a reflection of the mistrust that money has now in the US dollar, that it chooses, I believe, to put money here in excess now, I believe, of $600 billion that's invested in Bitcoin, as opposed to being it in cash in the US dollar. The market out there, people are looking for alternatives to the US dollar. And Bitcoin is one of them. We use GBTC, which is the Grayscale Bitcoin Trust, that is registered with the exchange, as opposed to trading in the Bitcoin unregulated market. At least here, I can be in the virtual currency market. I can trade it. I can benefit. I can have my money here at $5, and and this is just back in March, and it's at $30 today. So that's 6 times your money if you kept it. Very few instruments that are tradable assets can offer this. And right now, Bitcoin is the favorite trade, you might say, and so it is a tradable asset. I personally do not consider it as a currency, again, or competing with gold, the two different assets. This is a virtual asset, as opposed to the gold market being a virtual currency, a natural asset, a commodity, that is limited in production, and that's been around for thousands of years and has been used as God's money whenever fiat currency, or if you look at history in the past, other empires have collapsed because of imploding their currency, devaluing their currency. So to me, the gold market is an interesting market in many ways, not only as a tradable instrument, but economically and also politically. You know, it represents many, many dimensions of the economy and the financial markets. $36.10 up, 1895. The high was 1902. Now, 1904, it was the target, the weekly target, 1902. It was close enough, and you can see the reversion occurring. And that means that it pretty much identify supply begin to come into the market. It didn't quite activate it, but it's in that pattern. So let's watch this market here. If we look at the daily chart a little closer, these lines represent the Fibonacci trend lines, resistance trend lines. And as you can see here, the market, after making the low of 1767, it reverted back up above this descending channel. And upon testing the first leg, it appears that this now was the second leg, from a high of 1879 to a low of 1820, which is the recent low. And this leg here, from the low of 1767 to 1879, is about $100, over $100 move. It's about $120 move. So if this is the second leg of Elliott wave, if you use the wave counts, Elliott wave counts, the second leg was corrective always. It's a counter trend corrective from the first, confirming the first, activating the second, and upon confirmation of the second, the third unfolds. And the third leg basically should be double the first. So if you're looking at $120 move on the first leg, then from the low of the second leg of 1820, you're looking at $240 move above. So that would put the market at 2060 as the target for the next third leg using Elliott wave. When you look at that analysis and you see, for example, the market completed the second wave low at 1820, it coincided with the weekly buy signal of the codes that was saying by 1819. There's no coincidence. This is market synergy. And the code told you the completion upon the market confirmation. It unfolded the third leg, and that is the pattern that we're in right now by using classic Elliott wave. If you use the Fibonacci trend line resistance, what they signify is basically where the resistance initially comes in. And here you saw that this basically completed the first level of resistance, Fibonacci trend line. Market came down, tested the support below, came down to the weekly buy one level, reverted back again, activated daily and weekly numbers, triggers. It activated the weekly trend momentum, and then closing above that trend line, it just exploded as we are right now into the next target, which is 1904. 1904 matches exactly the next Fibonacci trend line. And this is a pretty strong level of resistance, you might say, that I think the market is going to show us the kind of strength underneath, the kind of buying underneath that could break this. And if it does, then you're looking at the next pattern to be about 1943 in terms of the Fibonacci trend lined resistance level. But you got to remember, as we take a look at the bigger signal, that we are in a bigger pattern unfolding here. With the first target of 1913. So this is how I begin to, use the numbers that we published daily, weekly, and monthly, that our trader subscribers have access to these numbers. It's a map. It's a treasure map. It's a gold treasure map, basically, that you can use as a trader to trade intelligently. Incorporating not only the Fibonacci trend lines that you see here, but also the Fibonacci retracement from the low that we made back in March to the recent high that we saw here at 2099. We came down into a 50% Fibonacci retracement right into this 1767 level. And this seems to be what the next low is going to begin from for the next leg. Now, one of the things I want to point out to you as I'm looking at the chart here, and this is as the market unfolds, what I'm looking at here is a possibility that we're looking at a head and shoulder bottom. And you're just looking at what the market is doing from a conventional technical analysis here. This is the left shoulder. This is the head of the bottom, and this is the right shoulder. And the market pretty much now has broken this right shoulder. And so you get the validation that, again, the 1947.50 area is the next target upon getting through 1913. And the market will tell us. Right now, it's entering into this target zone, resistance, and the market will tell us. So this is how I identify intelligently how I personally trade the market, taking into consideration all these fundamentals here that we're dealing with right now in the markets. We want to maintain, just hold on to the position, let the market take us, and just enjoy the ride as the market begins to meet the targets here. You can see that even in the Bollinger Band, that's on the upper end of the band. But again, the market is what will dictate, and it's dictating some huge buying here. So continue to watch the market here and see what it's telling us. The derivatives like Nugget have exploded tremendously. As you can see, a huge gap, and it's way above the daily target. So these instruments across the board on the derivatives have just, again, exploded tremendously. A little more buying down here, even though a little profit taking came in. The green bars represent basically the buyers that are taking the supply out of the market here. Continue to maintain your hedged positions. Synthetically long. The market continues to gain equity on the position. So our balances continue to increase as pretty much we wait for day trading opportunities that sometimes do not come in, but we are involved in the market from a core basis. We're long the market, and depending upon your profile, you can choose other instruments than the futures contracts to be able to trade these markets successfully. The application of the VCPMI can be applied for home office accounts, for individuals, retail, hedge funds. It is a mathematical probability models that identify for you basically the extreme levels of the supply and demand, again, which is the core essence of what makes the market. Once again, ladies and gentlemen, thank you for the privilege of your time. I hope that every day that you come here, you become a better trader. Please take care of yourself. I'll talk to you soon. Take care.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users who are on the go. Ticker Talker connects novice and